Well, Germany and most Germans take pride in the fact that they have this uh, that they're so-called export Weltmeister, the export champion of the world. They feel that that's sort of a sign of German industriousness and so on, and are loath to try to cut that back. How would you explain to them the necessity of at least balancing it out to some extent, or what would you give them as advice as to how to sort of soothe out the effects of that?
Well, there is, of course, as Richard Parker pointed out in our conference, a certain reflection of the historic Protestant ethic in this view, and in many ways, one has to sympathize with it. German success is the result of having a highly competitive industrial structure. But the number of points can be made. First of all, the process of European integration itself has moved both industry and agriculture from the peripheral countries to the core countries. So, and this is something which is inevitable in the process of integration. It has happened in the United States. It happened in Latin America. It happened in China in the reform process, one aspect of which was the removal of internal barriers to trade. So this is an inevitable process. The European Union understood it would occur, and in principle, they understood that there should be compensating flows going in the other direction. That's what the structural funds were for. The structural funds, however, were totally inadequate to deal with the scale of the concentration of activity that's occurred. So more compensation, more, and I don't mean that in a valulated sense, and more offsetting financial flows are required. And the Germans can basically make this happen in one of two ways, or one of three ways. They could, of course, cut back on their competitiveness. That would be a rather foolish and wasteful thing to do. It's hardly the case that we should have fewer or less good German cars. I mean, nobody would make that argument, I think, sensibly. German workers could live better, and German retirees could live better. In other words, the social wage could be increased. The wages for people who are not in the competitive industries and who are living substantially more precariously in Germany than was the case 15 or 20 years ago could be increased. So that's a second possibility. That would increase imports and reduce the amount of the current account surplus in Germany. And the third possibility is to facilitate financial flows to the countries that are in the debtor position. And that process, which is the recycling of money, can be done. No, there's no operational limit to it. The problem comes when it's done on terms that involve commercial credit, involve interest payments and an eventual prospect of repayment, which cannot be made because these conditions are not going to change. So long as Germany has a very strong industrial base, it is going to be the surplus country in the Eurozone. So it's not going to be the case that there will be, say, 20 years from now, a German deficit and a Spanish, Greek, and Italian surplus to offset it. So it has to be offset either by the first two means that I spoke of or by a routinization of the financial flows.
You mean something like a transfer union?
Yes, certainly. I mean, one way to do it,
Okay.
the United States became a transfer union after the New Deal and especially the Great Society. The New Deal created Social Security, which put pensions in the United States on a continental footing, gave a common standard to pension payments. Medicare and Medicaid gave a common standard to health care provision, particularly for the elderly and poor Americans. Of course, we have a military budget, which is regionally redistributive. It was greatly supported investment in the South. The New Deal had a large component of regional reconstruction, Tennessee Valley Authority, agricultural adjustment, rural electrification. There were a whole series of things that basically rebuilt the South of the United States, or built it for the first time, and industrialized it, and gave the that region the standing that it has now as basically an ordinary part of the United States. All of these things were a process of turning a non-functioning bi-regional economy in North America into a single coherent national entity. And that, of course, is a process that has not been completed in Europe.
Partly because of the language barrier.
Well, I think it's actually because of the national identification, and also because of the flawed design of European institutions. The idea that one would keep the social Europe at the national level and have a financial Europe at the regional level, this is not a workable idea.
Okay. Now, you've been talking at the conference about a paper that was put out recently about how to solve the euro crisis. People hear, of course, about rescue packages and so on, and they are kind of convinced that nothing's really going to work. They're going to end up paying for everything in the end, and the euro's going to disappear. What would...
I'm sorry, you're breaking up a little bit. Can you say that again?
Okay. People are afraid that they're going to be essentially, as taxpayers, stuck with the bill, and this is not going to end anytime soon. Now, what if you were to ask to present a solution to the Eurozone crisis, what would you recommend?
Well, we spent a good deal of time on that, particularly on Thursday, and had a very strong keynote address from Yanis Varoufakis about what he calls the modest proposal, which is a proposal prepared by him and with Stuart Holland, and with a substantial backing now from senior former leadership in the Eurozone. That part of the discussion was focused on the very short-term question of how one resolves the debt crisis, not necessarily how one resolves all of the other structural and architectural issues of the and policy issues of the Eurozone. But focusing on the crisis, the Varoufakis-Holland proposal is essentially, first of all, to have the Maastricht compliant part of the first 60% of GDP of all the Eurozone countries' debt essentially converted into debts that would be issued by the European Central Bank on a common basis at a common low interest rate, and yet serviced by individual governments as they are now. And that would have the effect of greatly reducing, eliminating to a very large extent, the credit market pressures on the Eurozone countries. Secondly, recapitalizing the banking system at the European level, and thereby breaking the current quite pernicious link between national banks and national governments. And thirdly, using the European Investment Bank as the source of a program of investment and redevelopment on the ground that this is an institution with a large capacity, a lot of projects on the shelf that it could, in fact, bring off the shelf if it were not crippled by current co-payment requirements. So that all of this was intended to work within the framework of European institutions, European law, a kind of minimally sufficient approach to resolving the immediate financial crunch and providing some foundation for economic expansion going forward.